Alright, so today I'm going to teach you about the mega backdoor Roth contribution. So this is a trick or a method you can use to stuff even more money into your tax advantaged accounts. So this is going to be something intended for people who are trying to save enormous amounts of money in a tax advantaged account, more than they can contribute to their 401k or their IRA. This is common for people maybe who are looking to retire extra early or people that make extremely high incomes. So let's look at all the different types of tax advantaged accounts, or at least some of the common tax advantaged accounts you might have available to you. So first of all is your typical work employer plan, which is a traditional pre-tax 401k or a Roth 401k. Now, I'm going to use 2017 numbers here. In 2017, you can contribute up to $18,000 into a plan like this. And with all this stuff, there's going to be all sorts of caveats. You might have a 403b instead of a 401k, but I'm going to speak to the most general situations that might apply to you. In addition to a 401k, you also probably have access to an IRA. So this is an individual retirement account that you set up on your own, not associated with your employer. Each individual can contribute $5,500 to a traditional or Roth IRA, and if you're married, you and your spouse can both contribute $5,500. Now, you may work someplace with a high deductible health insurance plan and have access to a health savings account. Now, of course, this is only intended to be used for medical expenses, but a lot of people in the early retirement community are actually using this for general savings because of some interesting details about the ability to withdraw from them in retirement tax-free and also contribute to them tax-free. So these are three of the most common vehicles for saving and investing in a tax-advantaged manner. Better than just investing in a normal brokerage account from a tax perspective. So what do you've got? You got $18,000 plus maybe up to $11,000 plus $3,000. This is a lot of money. If you are filling up all these buckets available to you and you still want to contribute even more in a tax-advantaged manner, that's what the mega backdoor Roth IRA contribution is for. And it's huge. Look at this. This is like equal to all the other accounts available to you plus some. In fact, you can probably contribute up to $36,000 depending on how much your employer contributes to your 401k. And it acts like a Roth contribution with all the tax advantages that come with it. So let's look into a little bit more detail. These are the contribution limits for a typical 401k account. You yourself can contribute $18,000, and oftentimes your employer will match something. So say you make $100,000 and your employer matches 6% of your salary, your employer will contribute $6,000. That can go on top of the personal limit of $18,000. However, that itself and everything else in your 401k is subject to a total contribution limit of $54,000 in 2017. Now, most people don't ever need to pay attention to this. All people worry about is that you can only do elective deferrals into a pre-tax or Roth 401k of $18,000. That's the common limit you'll hear talked about. However, there's another type of contribution you can make, these after-tax non-Roth contributions, and you can fill up to your total limit of after-tax non-Roth contributions, but remember your employer contributions count against this limit also. So when I said earlier you could use up to $36,000, that assumes your employer doesn't contribute anything at all to your 401k. If they do, you have to back that out of the total amount you can contribute. But it's still an enormous amount. So what is an after-tax non-Roth contribution? Especially if you watched my previous video on regular backdoor Roths, you probably have a pretty good understanding of the difference between traditional pre-tax 401k contributions and Roth 401k contributions. This is what they look like. In either case, let's say you want to contribute $1,300 in a given year or month. With the Roth 401k contribution, you pay income tax on the money you put into the plan. It grows and invests over the years, and when you take it out, say it's $3,000, there's no additional tax on it. You have tax-free withdrawals. A pre-tax contribution, you have no tax going in. Your money goes in prior to being taxed. Then it grows over the years. It comes out, since there's even more going in, there's more coming out. But then you're subject to income tax on the other end. Now, both of these are actually fundamentally equal, assuming you have the same marginal income tax rate in both scenarios. Now, let's throw this after-tax but non-Roth 401k contribution into the mix and see why it's different. Let's say you want to contribute the same $1,300. This is taxed. It's an after-tax contribution, so only $1,000 are going in. And say you have it grows to an investment of $3,000 just like a Roth contribution would. However, $2,000 of that is all earnings. You only put in $1,000, and so that $1,000 is earmarked as your contributions. The earnings you make on that are subject to income tax. So as you can see, this after-tax non-Roth contribution is inferior in every way to a traditional or Roth 401k contribution. That's why you would never use this if you still have space available in one of these typical types up to that $18,000 limit. You only use this type if you're trying to contribute even more. So what's so good about it, in fact? Why not just invest in a taxable account? Well, let's look into it. Let's suppose you're maxing it out. You've got your $18,000 traditional contributions, some employer contributions, and you're taking my advice and you've put in another 30 grand in a year into an after-tax non-Roth account. That money is actually allowed by the IRS to be rolled over into a personal retirement account, into your Roth IRA. Now, what does that do for you? This is the trick. Remember when I said your after-tax non-Roth contributions, if they stay in your 401k, any earnings they make are taxed at income tax rates. That's the downside. The money is taxed when it goes in, and when you earn it and withdraw it, all those earnings are taxed. However, if you, right when you make those contributions, while you still work for the company in the same year you make those contributions, if you roll those over to a Roth IRA, then they make Roth earnings, which are completely untaxable. It's just as if you had contributed 30 grand to a Roth IRA this year, which is crazy. And in fact, even if you make some earnings while it's still in the 401k that aren't taxed yet, and they will need to be taxed, the IRS clarified in 2014 that you can roll those over into a traditional IRA and roll all the contributions into a Roth IRA. So there's no taxable event at this time. All your gains are tax-free in the Roth IRA, and this traditional IRA can continue to make gains, but they will be taxed when you withdraw them, just like any other traditional IRA money will. So this is a huge advantage. Fundamentally, this money acts, this 30 grand acts just like a Roth IRA contribution. As you can see, this can be a huge addition to your portfolio of tax advantage accounts, and this can really accelerate your investment gains because you've reduced the tax drag on your accounts. Now, what does it take to be able to do this? Not everybody can do this. This requires some particular factors about how your employer's retirement plan is set up. First of all, it has to allow this type of contribution. Many plans still don't even allow after-tax non-Roth contributions. If that is your scenario, you simply can't use the Mega Backdoor Roth IRA contribution. Second of all, you really want your employer's plan to allow in-service distributions of that money. So that's that rollover. You want to be able to take that rollover in the same year, ideally, that you make those contributions. You put the money in and effectively immediately roll it over into the Roth IRA. Now, this is totally allowed according to the IRS rules, but some company plans don't allow it yet. Go figure. Now, the one caveat to that is if that money stays in your 401k and is growing with earnings that are going to be subject to income tax, you don't want to let that sit there for 30 years. If that's the case, you would have rather just invest it in a brokerage account, just pay long-term capital gains. But if you're only going to be at your employer for a couple years, when you leave that employer, then you can do this rollover to the Roth IRA. And you can even roll those earnings over into the traditional IRA, like I said. So if you're going to leave your employer sometime maybe in the next 5 years, I don't know, you'd have to do the math. But this may still be an advantage to you, even if they don't allow you to do that immediate rollover the day or week after you make your contribution. So I want to give you a little bit more information on the mechanics of how you actually do this. So if my 401k is at Fidelity and my IRA is at Vanguard, my plan allows after-tax non-Roth contributions and it allows in-service distributions of them. I'm going to call up Fidelity, my 401k manager, and tell them I want to do this. Now, it helps if you get someone on the phone who knows what you're trying to do and understands the Mega Backdoor Roth, and you explain to them that you want to make a direct rollover to your IRA accounts at another institution of your after-tax non-Roth account in your 401k. Now, they should help you do this. For me, at Fidelity, they can't do an electronic transfer. They have to send me checks. Checks are actually made out to Vanguard, so I'm not ever cashing them. I'm just going to forward them on to Vanguard. and then I send those checks on to Vanguard with a letter instructing them exactly what I want them to do. And here's an example. Enclosed with this letter are 2 checks for direct rollover from my employer 401k plan. This money was contained in my after-tax non-Roth employer plan. The check for $2,623 is a rollover of the non-taxable contributions, so all those contributions I made. And then the check for $76 is a rollover of the taxable earnings. So when I did this, I put in $2,623, and I didn't make this rollover for another few weeks, and I actually earned $76, which are effectively taxable in that meantime. So this is what I'm talking about, where I roll all my contributions into the Roth IRA, but I rolled the earnings over into a traditional IRA. So by doing this, I don't experience any taxable event this year. Of course, in retirement, when I withdraw money from the traditional IRA, that'll be taxable. And I also instruct Vanguard, which check is going into which account of mine and what I want to invest that money in. And I'm very clear which check numbers are attached. And so far I've done this twice, and Vanguard has gone very smoothly. I've had no issues with it. So this, for example, at this particular case, I already contributed $5,500 to my Roth IRA this year, and I put in another $2,623 to my Roth IRA with this method. So it effectively allowed me to bypass the Roth IRA contribution limit for the given year, which is absolutely crazy. So hopefully, I know this is only going to be applicable to a small section of the population, but I really hope it's interesting and useful. There's lots of written articles online on how to do this, but I thought a video might make it a little bit more clear. Let me know if you have any other ideas for videos that I can hopefully clarify any complicated investing or tax-related issues. I always check back on the comments on all these videos to see if there's anything else you guys need me to explain.